Welcome to your complete guide to the 7 best monthly dividend stocks. We will look into the companies that pay you every single month, explore the pros and cons of this investment approach, and show you how to build a reliable income portfolio.
This video covers 7 major sections, starting with why monthly dividends matter. We will review 7 dividend stocks, deep dive into their business models, explain the mechanics of how monthly dividends work, and finish with practical tips on how to invest and build a portfolio. Why choose monthly dividends? Because your bills arrive monthly, your income should too. Monthly payments also allow for faster compounding with 12 reinvestment events annually versus 4. This regularity brings psychological stability during market volatility and generally comes with higher yields, often 4 to 10 times the S&P 500 average. This chart clearly illustrates the income advantage. The S&P 500 averages only 1.15%, while monthly payers like Realty Income and Main Street offer yields ranging from nearly 4% up to over 10%. Remember, high yield often signals higher risk, especially in the double-digit range, which is why sustainability is key. Here is a quick overview of the 7 stocks. You'll see a mix of real estate investment trusts, or REITs, which own properties, and one business development company, or BDC. Risk ratings range from low for established players like Realty Income to high for those undergoing major transitions like Gladstone Commercial. First up is Realty Income, widely known as the monthly dividend company. They have paid 667 consecutive monthly dividends and have raised their payout 132 times since 1994. With a 4.92% yield and $60 billion market cap, it is the standard bearer for reliable monthly income. Realty Income operates on a secure triple net lease model, where tenants cover most expenses. They focus on essential recession-resistant retail. Despite their scale, their global addressable market is $13.9 trillion, suggesting huge growth potential that continues to fuel their 4.2% dividend growth rate. EPR Properties invests in experiences like movie theaters, ski resorts, and water parks. The high 6.04% yield reflects its pandemic-era challenges, including a dividend cut. However, the company is recovering and pivoting toward higher-growth experiential segments, offering investors a compelling recovery story. Agree Realty is the essential retail play, focusing on freestanding properties leased to supermarkets, drugstores, and home improvement chains. Their tenants are resistant to e-commerce and recession. Agree offers a lower but highly secure yield of 3.96%, supported by a robust 5.3% dividend growth and long lease terms. LTC Properties is a healthcare REIT focused on senior housing and skilled nursing. The investment is driven by the massive demographic tailwind of America's aging population. Although the pandemic hit tenants hard, LTC maintained its monthly dividend, offering a stable 5.79% yield while waiting for future growth to resume. Gladstone Commercial offers a high 10% plus yield, but comes with high risk due to a 2023 dividend cut caused by struggling office properties. Management is now executing a pivot from office to industrial real estate, making this a high-risk, high-reward investment dependent on the success of that transition. SL Green is Manhattan's largest office landlord. The pandemic forced a severe dividend cut, but the company is stabilizing its balance sheet by selling non-core assets. A recent 3% dividend increase signals a recovery. The 6.35% yield compensates investors for the inherent uncertainty in the commercial office market. Main Street Capital is the outlier, a BDC, not a REIT. They lend to and take equity stakes in private middle-market companies. It is internally managed, which is a major advantage. Since their 2007 IPO, they have delivered exceptional returns and growth, paying a regular monthly dividend plus frequent special dividends. Monthly dividends work as follows. A company earns income, covers costs and debt, and then distributes the remainder monthly to your account. Key terms include dividend yield, the triple net lease structure, and the REIT requirement to distribute at least 90% of income. Remember to utilize a dividend reinvestment plan, or DRIP, to accelerate compounding. A real estate investment trust, or REIT, allows ordinary investors to access large-scale real estate. By law, 90% of taxable income must be distributed annually, which creates structurally high yields. Additionally, 75% of assets must be real estate, and 75% of income must come from real estate sources. Monthly dividend stocks offer 6 key advantages. They provide better cash flow alignment, faster compounding, and often deliver superior yields compared to the broader market. Their structure offers reliability, promotes investor discipline during downturns, and many payers offer growth that resists inflation. It is important to assess the risks honestly. These stocks carry a high sector concentration risk, mostly in real estate. High yields can signal high risk of dividend cuts. REIT dividends are also taxed as ordinary income, making them tax inefficient in taxable accounts. They also face interest rate sensitivity and limited business diversity. To invest, first open a brokerage account. Choose a tax-advantaged account like an IRA for REITs. Search using the correct ticker symbol and use a limit order to control your purchase price. Enable a dividend reinvestment plan, or DRIP, to maximize compounding and monitor the company's performance quarterly. Tax location is critical. The Roth IRA is best, as growth and dividends are tax-free. A traditional IRA is good, offering tax-deferred compounding. A taxable account is acceptable for lower tax brackets, but significantly reduces your net yield due to ordinary income taxation on REIT dividends. A simple portfolio framework uses 3 tiers. Core holdings, representing 50 to 60%, should be highest quality, like Realty Income. The complement tier, 25 to 35%, includes solid businesses like LTC and EPR. Finally, the satellite tier, 10 to 15%, is for higher risk, higher yield turnaround stories. Dividend reinvestment is a powerful tool. In this example, a $20,000 investment reinvesting dividends monthly grows to nearly $70,200 over 25 years. This is almost $2,000 more than quarterly reinvestment, highlighting the compounding benefit of monthly dividends. DRIP can be easily set up through your brokerage. When comparing monthly to quarterly payers, monthly payers offer better cash flow alignment and faster compounding due to 12 annual payments. They generally provide higher yields, but typically have limited sector diversity, while quarterly payers offer better tax treatment and broader business type exposure. As a dividend investor, monitor key metrics quarterly. For REITs, track funds from operations per share, occupancy rates, and debt levels. For BDCs, monitor net investment income per share. Always observe the dividend growth rate, as consistent growth signals management confidence. Avoid these 5 common mistakes. Do not chase the highest yield without assessing the risk. Do not build a portfolio of only monthly payers, as this lacks true diversification. Make sure to use tax-advantaged accounts effectively. Avoid panicking during rate-driven sell-offs, and never stop reinvesting dividends during the accumulation phase. To summarize, monthly frequency is a genuine advantage that solves cash flow problems. Quality is essential. Focus on the highest sustainable yield. Use Realty Income as your benchmark for reliability. Tax location is critical for maximizing after-tax returns. And remember, these stocks are a component of a larger diversified portfolio. Thank you for watching this video on the best monthly dividend stocks. Remember that the goal is the highest sustainable yield. We encourage you to combine the strength of these monthly payers with broader diversification for long-term financial independence. Consult a qualified financial advisor before making any investment decision.